Namaskar, this is Akhilesh Bhargava. Welcome to Tit-bits on Business and Finance with me. As the Ukraine war only intensifies further with no end in sight, a worrisome downgrade of macros, growth, and economic prospects and expectations is the norm now. Hopes of any early economic recovery have taken a backseat at present amidst times of uncertainty and a slowdown in the world economy. The estimates of growth are being scaled down not just for India, but for other nations and for the world too. A spate of sharp downgrades of growth estimates for the Indian economy have therefore been already reported in the past few weeks. One agency after the other has been downgrading India's growth prospects for the current financial year. The World Bank now predicts that the Indian economy will grow by 8% during the current financial year as against its earlier estimate of 8.7%. Fitch has brought down its growth estimate for India to 8.5% as against its earlier figure of 10.3%, which is a substantial cut in the growth estimate. Morgan Stanley has scaled it down to 7.9% from its earlier estimate of 8.4%. Citibank's growth estimate now stands at 8% for India as against its earlier projection of 8.3%. The Reserve Bank cut its growth estimates to 7.2% as against its earlier figure of 7.8%. And so has the IMF brought it down to 8.2%, unlike its earlier estimate of 9%. As the uncertainty and disruption continues worldwide, further downgrades of growth are not ruled out. It all has to do with the war causing the disruption and the rising inflation, both coinciding with the onset of withdrawal of surplus liquidity by the USA and other nations. So why have the growth estimates been cut for India? The World Bank cited the tepid recovery in consumer demand in India and the escalating uncertainties of the war while cutting down its growth forecast for India. The World Bank said that the recovery in private consumption will be constrained by the incomplete recovery in India's labor market, and inflationary pressures weighing on the purchasing power of households will again constrain the consumer demand. It then said that economic recovery has been uneven across sectors in India. The rise in energy and food prices will hit the poor households the hardest, exacerbating rising inequalities. The World Bank then says that though South Asia has limited trade and financial links with Russia and Ukraine, yet higher commodity prices in the global markets will drag down this year's GDP growth in South Asia also. The high commodity prices will weigh on import demand, and lowering growth abroad will lead to softening of demand for South Asian exports, including those from India. And it then says that foreign investors have already started exiting India's financial markets since October 2021 because of the impending tightening by the US Fed. Recent developments in Eastern Europe have intensified the capital outflow, weakening the Indian rupee. Thus, maintaining macroeconomic stability according to the World Bank through prudent and transparent policies will be extremely important for India. Those were the reasons why the World Bank has effected a cut in India's growth rate as it expects. The IMF too in a recent report has scaled down India's growth estimates for the financial year 2023 to 8.2% from its earlier figure of 9%. The IMF cited the impact of high global prices on domestic demand and poor private investment in India for this particular downgrade. The IMF also slashed its global growth rate projection during the year to 3.6% from its earlier estimate of 4.4%, saying that global economic prospects have worsened significantly due to the commodity price volatility and supply chain disruptions. And it said that the economies of Russia and Ukraine will contract significantly during this calendar year 2022. The IMF also scaled back its global trade growth projections by 100 basis points and warned that all these downgrades and forecasts were fraught with heightened uncertainties and risks to the downside, indicating the possibility of further cutbacks in its growth estimates for sovereign economies and also in respect of the world economy. What did the IMF have to say about the Indian economy? About India's economy and growth prospects, the IMF further said that besides crude oil prices, the rising prices of edible oils and fertilizers would also impact India's external position, irrespective of its forex buffers, which it says should, however, be a comfortable cushion to withstand such massive external shocks. The IMF then said that India faces lower external demand, particularly from Europe, heightened uncertainty, and lower investment confidence. These are the other factors that it faces. It estimates India's average inflation rate during the current financial year to be at 6.1%, certainly above the RBI's tolerance band for inflation of 6%. So while the Ukraine war is impacting growth worldwide, however, in the case of India, the impact will be particularly visible due to its high dependence on the import of crude oil, edible oil, and fertilizers, whose prices have shot up because of the Russia-Ukraine conflict. This war has given a boost to inflation, and the worst sufferer will be the Indian middle class and the Indian poor, who are already facing loss of livelihood, loss of employment, and they are facing depleted household income and wealth. And as the IMF said, and the World Bank also said, it is reflecting on the reduced consumer demand or spending in the country. While each nation will have to tackle the crisis in its own way, yet, since it is a worldwide crisis, some think that a coordinated global effort should be initiated in order to mitigate and battle the crisis. India's finance minister, speaking at a recent G20 meet at Washington, thus said that she says that there is an urgent need for a coordinated action amongst nations to enable a swift economic recovery post the COVID pandemic and to also build resilience to future shocks. She flagged near-term policy challenges for emerging economies, including food and energy security and the tightening of global financial conditions. The FM stressed the need for environmentally sustainable and financially viable alternative energy sources for every nation. The FM, while speaking at yet another event there, remarked that India is one of the better destinations for doing business and that despite challenges, the government has been able to move forward with systemic reforms. She said that India's economic recovery from the pandemic has been sustained and pronounced. The fact of the matter is that compared to many other nations, the Indian economy has not performed as badly as the others did, despite 2 years of the corona pandemic. The Ukraine war has certainly caused a huge crisis for the global economy, with a slowdown in growth amidst rising inflation and supply bottlenecks. The finance minister may call for a globally coordinated action, thus seeking cooperation among the nations to battle a common problem, a common enemy, but that is unlikely to happen according to us. The fact is that while the current economic slowdown and problems like inflation, supply disruption and financial tightening are indeed global problems, yet the resolution thereof is the individual responsibility of every nation. Though all nations face these challenges, yet each one of them is on its own in order to combat and mitigate them. That's not just because the problems of each nation are unique in themselves and that there is no standard general solution for them, but it is also because most nations today face weak macroeconomic fundamentals and are in no position to financially help the other beyond a point. The treasury of most nations today is stretched and it is loaded with debt, and thus they cannot reach out to help others even under a joint global effort that the finance minister proposes. And ultimately, it is the market forces that determine and dominate economic matters. No amount of global coordination between nations will bring down the price of crude oil, edible oil, etc., unless they completely stop its consumption, which is not possible. Consumption of crude oil, edible oil will continue, and the market forces are going to dominate the kind of pricing that takes place. Moreover, no amount of such cooperation will be able to restore the supplies of commodities or debottleneck them if the war continues. And two major production nations, which is Russia and Ukraine, are kept out of the global supply chain because of this. So, however much you cooperate, if the war continues, this crisis that is impacting the economies of so many nations is going to continue. Each nation needs to look after itself, and its own national interests will supersede those of all others, particularly in an era of geopolitical friction, trade wars, and fractious diplomacy. A live example is thus that of Sri Lanka and perhaps Pakistan very soon. Their economies have collapsed, and there is no global coordination whatsoever to bail them out of their crisis. The only option for these nations is to appeal to friendly nations for help, as in the case of Sri Lanka requesting India and India helping it out. And there is no coordinated global support in these kind of instances. We are not seeing any general global support come to the rescue of Sri Lanka, and it is battling its crisis on its own. Yet another case is the proposed financial tightening by USA, which is impacting so many other nations, but yet the US is proceeding with it, since that is in the best interest of America. As we said, each nation is on its own. That's the case with India too, which needs to fend for itself and deal with its problems without expecting any support or assistance from any other nation. The best strategy for India to trigger durable recovery, in our opinion, would be to make itself a major producer as well as the consumer in the world, which it will lead to not just economic recovery for India, but also long-term growth. That's how India would become a 5 trillion GDP and beyond. We need to be the producer, we need to be the consumer also, and you'll see growth coming back in good numbers. For doing that, India needs to trigger the virtuous cycle of private investment, which is at a standstill at present because of poor levels of ease of doing business at the ground level, because of onerous laws with high cost of compliance, because of its infamous red tape and corruption, and because of sheer lack of investor confidence in the system about investment safety. If India wants growth to come back, it will need investments to come back. Until that doesn't happen, we will also continue to languish. This is Akhilesh Bhargava signing off till we meet again. Namaskar.